Welcome back to DIY Finance Guy. I'm Sergey Modilevsky. In today's video, we're going to be focusing on the 5-year Canada bond yield, which continues to rise higher. This is largely off the back of last week's employment reporting, which indicated that Canada continues to grow its economy, adding about 21,000 jobs compared to the expectation of 20,000 jobs, but more importantly, seeing a sustained growth in average hourly earnings. Now, those earnings are trending at roughly 2.5 times the Bank of Canada's target of 2%. Earnings are growing at about 5.5%. It's a big issue, and it gives a lot of ammunition for the central bank to continue hiking interest rates. We're going to be exploring how these continued interest rate hikes are going to affect asset prices, most importantly, real estate. So let's jump into it. But before we do, I'm going to ask that you please look down and click that little thumb. By hitting the like button, it ensures that this video gets out to the people that really want to see it, and it helps this channel and community grow. I really do appreciate it. Now, let's jump into it. These are the 3 prongs that are affecting new home buyer sentiment. There's borrowing capacity, there's down payment capacity, and there's how our everyday earned income is being affected by rising prices. There's pressure across the board. New home buyers have less borrowing capacity, they have less down payment capacity because asset prices continue to fall, and any prospective down payments that they'd receive from a family member also continue to fall in value. Inflated prices across the board in the economy, not only on finished goods, but also on services, also continues to impact their ability to save. We're facing the least affordable housing that we've seen in decades. In all likelihood, the Royal Bank of Canada's forecast that prices will continue to fall another 14% by spring 2023 are likely to come true. Now, whether they fall 14%, 10%, or if they stagnate from here on out until spring, it's pretty clear that new buyers are not going to rush back to the market, and not out of a lack of desire. They're simply constrained. Looking now at Canada's 5-year bond yield, we could see a huge escalation in the yield from October 5th. Now, in that week, we saw reporting around employment, and we saw above expectation growth both in jobs and average hourly earnings. It's that gives munition to central bankers to continue on their rate hiking trajectory, because central banks have 2 mandates. One mandate is around maintaining full employment. This reporting essentially made it clear that we are still very much at full capacity, with not enough job openings declining and the full employment rate rising. We also saw an increase in average hourly earnings, and as a result, we saw the 5-year bond yield take off. Let's have a look at the actual reporting and try to understand what it means. All jobs-related reporting was for the month of September, and it includes the unemployment rate, full-time employment, the participation rate, and most importantly, average hourly wages, as you can see here. We're going to start by looking at the unemployment rate to better understand what sectors of the economy continue to add jobs, while other sectors of the economy are slowing down. The unemployment rate in Canada eased to 5.2% in September of 2022 from 5.4% in the previous month. That beat expectations of 5.4%. Instead of stagnant job growth, we actually saw an increase in jobs. The number of unemployed people fell by 41,400, and long-term unemployment fell by 18,000 to make up for the rise in August. On top of that, employees rose by 21,100, beating market estimates and breaking 3 consecutive months of previous declines. What we saw was a lot of growth in education services and healthcare and social assistance. That was offset by losses in manufacturing and information, culture, and recreation. Also, employment rose in the public sector, while private sector and self-employed workers were little changed. In the meantime, and of high importance, the labor force participation rate fell, matching the 14-month low that was hit earlier this year in July. This is essentially the trend in unemployment that we've seen since October 2021. Despite rising interest rates, we've seen pretty strong employment, and that is why central bankers still have the authority and the mandate to continue increasing interest rates. Let's carry on, and look at the average hourly wages. Looking down here at average hourly wages, we could see that the number came in at 5.2% on a year-over-year basis in September. Why it's so important is because the Bank of Canada's inflation mandate is 2%. If wages are growing at 5.2%, that means that we're going to see a lot of pricing pressure on any goods that are manufactured in the economy. Unless we see a significant increase in the output of goods produced, we're going to see increasing pricing pressure as a result of this number here at 5.2%. Look at Canada's labor force participation rate. This has been a real conundrum for central bankers, not only in Canada, but around the world, to understand why so few people are entering the employment workforce. So to give you the definition, the labor force participation rate is the number of persons who are employed and unemployed, but looking for a job divided by the total working age population. The total working age population continues to decline in Canada as some of our largest age demographics are now aging out of the workforce or choosing to retire early. Some of that number is supplemented by a high level of immigration, but as we know, there are a lot of hurdles that are created for international students and new migrants to enter the workforce, particularly in productive jobs. Now, this number has been trending well below its 10-year trend line, which we can see here. That number obviously capitulated back in 2020 as we entered COVID lockdowns, but even since, during the recovery, that participation rate has remained well below its 10-year trend line and continues to trend down. Not my place, but I'm still going to offer my 2 cents on this number. We know the baby boomers and Gen X have accumulated an incredible amount of asset wealth. There's something to be said that there may be this consortium of people who are sitting on the sidelines, possibly waiting to inherit that wealth from their parents, because we do see that that participation rate remains stubbornly low. A lot of the subsidies that have been available for workers who were temporarily laid off as a result of lockdowns are now gone. They're behind us, but that participation rate hasn't rebounded. The cost of living continues to grow. Any form of borrowing cost continues to grow, but that participation rate remains stubbornly low. As we see a longer duration of higher interest rates, it'll be very interesting to see if that number bounces back in the months and quarters to come. So interest rates affect capacity in 2 ways. One, they affect borrowing capacity, which is what we discussed a moment ago, but they also affect down payment capacity and consumer sentiment. So let's have a look at that as well. When we talk about down payments, that's essentially taking assets from one place and using them towards the purchase of real estate. Now, typically, a down payment is made up of assets that are sold either from GICs, from bonds, or the stock market. We know as yields rise, the return on bonds falls. So there's a lot of long-term bond funds that are actually down 12, 15% on the year or more. Let's have a look at the stock market. We could see that over the last 5 days, the stock indexes across the board in North America have trended down in a really material way. Canada's main index, the S&P TSX Composite, is down about 4.8% over that 5-day stretch, and all U.S. indexes are down in a material way as well, with growth in particular, like the NASDAQ Composite, down 4.1%. I'm not going to pull it up here, but I can assure you the crypto index is also down in a material way. And like I mentioned a moment ago, bond funds continue to fall as yields continue to rise. So not only for primary homeowners, like for example, middle-aged person, but also for any potential parents that are looking to provide down payment assistance towards a new home buyer, they're also dramatically affected by this fall in asset prices. And that's going to affect the buyer sentiment that's out there and for consumer demand to buy new homes. We've discussed how borrowing capacity is being squeezed, how down payment capacity is being squeezed. Let's look at how people's day-to-day spending has also been affected over the near term. Let's look at the price of commodities to understand how certain input costs are going to affect people's day-to-day lives. There's some in particular that will affect more than others. If we look at the price of crude on a 5-day trend, we could see this massive bounce back. If we look a little bit further, if we look at the 1-month trend, we could see that prices kind of capitulated down to about $76 and have rebounded in a really sharp way. The reason prices fell in the first place is the United States has been emptying their reserves in order to provide a cheaper cost of gas to the consumer. But OPEC Plus basically stated that they're going to be cutting their output. And as a result, we saw prices skyrocket over a very, very short, roughly week and a half, 2-week window, settling up to about $93 before trending down over the last couple of days. It's highly likely that we're going to see the federal government in the United States step in, create some form of intervention, whether it be a price cap or domesticating production, and that'll likely force the price of oil down. But overnight, we saw the price of gas in Canada jump in a really material way. That's hitting consumers' pockets. That's making it more difficult to save money towards that prospective down payment that would be used towards a home purchase. Thank you to everyone for tuning in. I'd really appreciate, again, if you could please hit that like button. If you could leave a comment, doesn't matter what you comment. You can comment on the state of the weather out there, state of the economy or housing. Doesn't matter, but I'd really appreciate it because it helps put this video into the hands of those that want to see it, helps grow this community as well. Thanks again for tuning in, and I'll look forward to seeing you in the next one.